Hey guys, welcome to All Things Graft. The purpose of today's video is to attempt to explain the value of cryptocurrencies. Many people today believe cryptocurrencies are simply just another asset to speculate on, another investment vehicle like a stock or a commodity that can be traded to make money. Now, although you can make money trading or investing in cryptocurrencies, this is not why they were created. In order to understand the true purpose of cryptocurrencies, we need to understand the history of money. There's just no way to really appreciate their value if you don't have a basic understanding of how we got to where we are with our current monetary system. Now, in order for you to really understand this story, we must first understand how our current monetary system works. To do that, all we have to do is answer a simple question. Where does money come from? In the US, and in almost every other country in the world, new money comes from two places. A regular bank, like the ones you see all over the place in town, and from the country's central bank, which in the US we call the Federal Reserve. A regular bank creates new money every time it gives out a new loan. If you've ever borrowed money to buy a new car, a new house, to finance your business, or even just bought something with a credit card, you've received brand new money that bank created out of thin air. Now, there are regulations which limit how much new money a bank is allowed to create, and it's based on how much money the bank has in deposits. This is why banks are always trying to push people to open up new bank accounts and make a deposit. The more money they have in deposits, the more new money they can create, and the more money they can lend out. Now, banks aren't in the business of giving out free money. Banks lend out money in order to earn money. They give you a loan so you can pay back that loan at a future date with interest. The interest is how the bank earns its money. Now think about that for a moment. The bank creates new money for free out of thin air. It lends it to you so that you can pay it back at a future date with interest. How does a bank get away with that? And what about the US Central Bank, the Federal Reserve? How do they make money? Well, they create money in the exact same way, except the only ones allowed to borrow money from the Federal Reserve are regular banks. The only difference between how the Federal Reserve creates money and how regular banks create money is that the Federal Reserve is not required to have any deposits or any money in its accounts. They can simply just will money into existence. You see, you and I, we work to earn our money. Regular banks and the Federal Reserve don't work for their money. They just create it. But wait a minute. You could argue that the Federal Reserve is part of the federal government and that the government should always have the power to create money. They need to create money to pay for public works and to fund our military so they can keep us safe. Well, that's where you're wrong. The federal bank is not part of the US government. In fact, there's actually nothing federal about the Federal Reserve. The Federal Reserve is just another private bank with shareholders that hold stock and earn interest. And can you guess who those shareholders are? Other regular banks. You see, our entire monetary system is controlled and run by banks, and only they have the power to create money. And remember how I said that banks aren't in the business of giving out free money? Well, neither is the Federal Reserve. The US government gets its money from loans it receives from regular banks. Regular banks get their money by simply creating it or by borrowing it from the Federal Reserve first and then lending it to the government. The money lent to the government must then be paid back at a future date with interest. And where does the government get the money to pay back the loans and interest? From you and I in the form of the income tax. You see, you slave away all year long working for someone so you can earn money to provide for your family. And at the end of the year, you must have saved enough money to pay your income tax so that the government can pay back the money they owe the banks. Money which was originally created out of thin air. And if you don't pay that money up, you'll go to jail. Does this sound like a fair system to you? Our entire monetary system in the United States is a huge central bank-run scam on the American people. Don't believe me? Check this out. The US government began collecting the federal income tax back in 1913. Can you guess the year in which the Federal Reserve Bank was created? That's right, 1913. Do you really think this is a coincidence? The founding fathers of the United States of America knew of the scam behind central banks and how devastating they could be to the people of a nation. So much so that they made it unconstitutional for there to be one in America, yet we still have one. But how could this be? How can a nation built upon the principles of freedom be governed by a monetary system of slavery? And how do cryptocurrencies play a role in any of this? Well, like I said, in order to understand the true value of cryptocurrencies, we need to understand the history of money. So, let us begin our story. In our very early history, people didn't use money. Instead, they traded what they had for something they wanted. This was called barter. If I had apples and I wanted bananas, I could trade my apples with someone who had bananas. Except, if the person that had the bananas didn't want any apples, then I wouldn't be able to get any bananas. So what happened over time is that instead of people trading their own things for goods or services, they began to use a system of money. At first, people began to use things like feathers, beads, and seashells as a form of money, but eventually moved on to using gold. Why? Well, because gold is attractive, it's soft, and it's easy to work with. Goldsmiths, for example, were able to easily turn gold into coins, which could be used as money. As people began to transact with gold and started accumulating lots of it, they began to have a problem. People started stealing their gold. So, needing a way to keep their gold safe, they asked their local goldsmith if they could store their gold in his vault for a fee. The goldsmith would agree and began issuing out paper receipts known as IOUs, which showed how much gold a person had stored in the goldsmith's vault. If you ever wanted to withdraw your gold, all you would have to do was show the goldsmith your IOU. Soon, people began using the goldsmith's IOUs as money because it was pretty much as good as gold. Thus, the very first form of paper money was born. Now, it didn't take long for the goldsmith to realize that people rarely ever came to his vault to withdraw any gold. So, he came up with the idea of giving out loans in the form of these IOUs from which he could earn interest. This turned the goldsmith's business into the very first bank. Now, this lending of IOUs worked great for some time, and it made the goldsmith very rich, but greed began to set in. Eventually, the goldsmith started loaning out more IOUs than he had gold to back them up. As he kept making more and more of these IOUs, which weren't backed by any gold, people started to notice that things were becoming more and more expensive. You see, as the goldsmith made more IOUs, people began to have access to more of this new form of paper money. The more of this new paper money there was, the more people were willing to spend it. If I was previously charging 1 gold IOU for an apple and decided to raise the price to 2 IOUs, then people wouldn't mind paying the higher price because there was so many IOUs going around. This is what economists call inflation. It is the depreciation of the value of an economy's paper money as more of it is created. Now, going back to our story, as inflation increased, people began to suspect that the goldsmith didn't actually have enough gold to back up all of his IOUs. So, little by little, people started withdrawing their golds from the goldsmith's vault. As word got out, more and more people began making withdrawals, which eventually ended up causing the very first run on the bank. Those who went to the bank first were able to get their gold, but eventually there was no more left. The rest were left with nothing except worthless pieces of paper. In the end, everyone had to go back to using gold as money. Now, the goldsmith's business didn't go unnoticed. In fact, many people thought this banking business of storing gold and loaning out paper IOUs to earn interest was a brilliant idea. It was a great way to help expand an economy very rapidly. So, as time went by, governments decided to implement the goldsmith's banking practice, but made sure to regulate it so that what happened to the goldsmith wouldn't happen again. This gave rise to central banks, which were formed in order to set rules and regulations that all other banks must adhere to. Now, throughout history, all central banks have shared the same fate. They've all failed. Why? Well, because they all go through the exact same cycle that the goldsmith went through in our story. First, the economy starts off with a gold-based monetary system. Then, banks and government come along and offer to store gold and IOUs, which give rise to a paper money monetary system that's backed by gold. Then, central banks are formed and take over the banking system with the promise to regulate it. Eventually, because of the incredible amount of government spending, central banks end up tricking the government and its people to come off the gold-backed standard so they can spend more money and help, quote, boost the economy. This in turn leaves the central banks with absolute control of the monetary system, leaving us with worthless paper money unbacked by anything. At this point, it's no longer considered paper money, but simply a currency. Now, as regular banks and central banks begin the mass production of this new paper currency, inflation begins to set in, causing things to become more and more expensive. Soon, people begin to lose confidence in the banking system, along with its new paper currency, as more and more people become aware of the scam. All it takes at this point is a country to go to war, or for there to be some type of financial crisis that forces central banks to print more currency, which ultimately leads to its complete devaluation, and the whole system comes crashing down. The takeover of a government and its economy by central banks has happened over and over again throughout our history, and it's exactly what has happened to the United States along with every other country in the world. You see, we've fallen victims to central banks once again, but unlike in the past, we now live in a digital age, and for the first time in history, we actually have a way out of the banking system, and it's called cryptocurrencies. Cryptocurrencies, or what I like to call freedom currencies, are a new type of digital monetary system. They are decentralized computer programs that run on thousands of computers around the world, each holding a copy of every single transaction that has ever occurred on a cryptocurrencies network. If one of the computers on any network were to be turned off or forcefully shut down, then it wouldn't matter because all other computers on the network would continue to run the program. This makes cryptocurrencies almost impossible to be shut down by any government or any organization. The only way to shut them down is to cut off the power and the internet to the entire world, which is highly unlikely. And even if this did occur, the network would pick up right from where it left off once the power is restored. Almost all cryptocurrencies are programmed to produce a limited number of coins, which means they can't suffer from the devaluation effect caused by inflation. And they are so incredibly secure that even the most powerful computers on Earth are incapable of hacking the network. But here is the most important thing about cryptocurrencies. They completely eliminate the need for us to rely on banks. You see, once you create your own cryptocurrency wallet, all you ever have to do to receive money is to give out your public key. This is the equivalent of giving out your bank account number. To send money, all you need is your private key, which is the equivalent of a highly secure PIN number. As long as you never give anyone access to your private key, your money will always be kept safe on the network. Now, there are many different types of cryptocurrencies out there, each with its own specific use case. Let's go over a few of the most popular ones. The most common cryptocurrency around at the moment is Bitcoin. Bitcoin's specific use case is that of a decentralized digital currency. Its job is to be used as online money to purchase goods and services over the internet. It is considered by many to be digital gold, as it shares many of the same characteristics as real gold. Litecoin is another similar digital currency, and it's considered to be the silver to Bitcoin's gold. Monero is a digital currency that is completely private and untraceable. Think of it as a Swiss bank 2.0. Dash is a combination of both Bitcoin and Monero, with its privacy feature being optional. Ether, the second largest cryptocurrency by market cap, is a cryptocurrency found on the Ethereum network. Ethereum is a platform where developers can build dApps, or decentralized applications. Think of Ethereum as a world computer that is always on and could never be shut down. Ripple, the third largest cryptocurrency by market cap, is a global real-time settlement network which aims to connect banks around the world and allow for cross-border payments. Its goal is to help banks survive in this new era of cryptocurrencies. Now, if you're against the existence of banks, you probably don't like Ripple very much. NEM, or the Smart Asset Blockchain, is built as an enterprise-grade solution that enables businesses to easily implement the use of blockchain technology without them having to rebuild their entire business infrastructure. Think of NEM as a plug-and-play blockchain for businesses. Now, there are many more different types of cryptocurrencies out there, each offering different types of blockchain solutions. In fact, there are over thousands of them, and there isn't enough time here to cover them all. But there is one more cryptocurrency I'd like to quickly mention in this video before we wrap things up, and that's Graft. Graft, which stands for Global Real-Time Authorizations and Fund Transfers, is a decentralized and open-source payment platform which enables for the processing of real-time authorizations and settlements of merchant payments. You see, the problem with almost all cryptocurrencies right now, although being revolutionary, is that they are simply too slow to be used at point-of-sale terminals. This is why you almost never see any gas stations or grocery stores accepting cryptocurrencies as a form of payment. Confirmation times are just way too slow, which doesn't allow them to compete with transaction speeds like those of debit cards and credit cards. The Graft payment platform, however, enables buyers to utilize cryptocurrencies to pay at any compatible point-of-sale terminal, and it does so with instant authorizations. For a cryptocurrency enthusiast like myself, Graft is a very exciting project, which could potentially catapult cryptocurrencies towards mainstream adoption. Now, for those within the cryptocurrency community that are on the lookout for potential income opportunities, you may be interested to know that Graft is building a completely decentralized payment ecosystem, which requires many market participants in order to fully function on a global level. These include miners and supernode owners, exchange brokers, application providers, merchant service providers, credit card gateways, payment brokers, and regional boards, all of which will come together to facilitate seamless cashless transactions between consumers and merchants at minimum cost. Now, I've already made a few videos regarding Graft's potential, so I won't go in depth in this video, but I do encourage you to check them out. I really hope you found this video informative and educational. To conclude, I'd like to leave you with a short audio clip of a response given by Mike Maloney when asked his opinion about the attempt of governments to regulate cryptocurrencies. His response completely summarizes the main point that I'm trying to get across in this video. Take a listen.
The only thing that they can do is to regulate the exchanges, the points where you convert cryptocurrencies into national fiat currencies. And if we start using cryptocurrencies more in exchange, where we're buying things with it, that's what's going to lead to freedom. And just playing around with it and trying to trade this cryptocurrency for that one and to try and make some speculative gains, that's not the real point here. The real point here is that we have the opportunity now to have a new world. The world monetary system is engineered to benefit a few at the expense of the many. It's engineered to transfer wealth from the average person to the people that run the game, the banks, the financial sector, and the central banks. And the cryptocurrencies undermine that, and they transfer the control of one's destiny into the hands of the individual. Instead of being a victim of what is happening, you get to be the master of your own life.